Today I'm going to be talking about one of the primary option Greeks. That option Greek is delta. Now delta, in my opinion, is the most important of the Greeks because as a trader, you should know the delta of each and every one of your options position because delta gives you so much useful information. Delta is really crucial in helping you manage your options portfolio. So before diving a little deeper into delta, let's first talk about what exactly are the option Greeks. When we talk about the Greeks, what are they? Well, the option Greeks are important metrics that help you monitor your current option positions. There are four primary option Greeks. They are delta, theta, gamma, and vega. Now, I mentioned that the Greeks are used to help you manage your current options positions. The Greeks are not really used in trade selection, right? The Greeks don't determine whether you open a new trade or not. The Greeks are mainly used in monitoring positions you already have put on because the Greeks, what they do is they tell you how that position that you already have on, whether it's working for you or not, whether things are going well or going poorly for that current position. For the trade selection process, you really should be much more focused on other things like liquidity, probability of profit, implied volatility rank, risk versus reward, and things like that. Those are the metrics that really determine whether that trade, that new trade you're thinking about putting on, is worth it or not. The Greeks, again, are used, after the trade is put on to help monitor the position. So let's define delta. What do we mean when we talk about delta? Well, delta is the theoretical estimate of how much an option's value will change if the underlying stock moves up or down by $1, assuming all other factors are held constant. Calls, they have a positive delta ranging from 0 and 1, while puts have a negative delta ranging from -1 to 0. So if I switch over to the TASTYTRADE platform, I'm just going to pick a stock here. We'll pick Google, and let's go to the option chain for Google. And if I open the option chain, if I take a look at the calls, and I've got this column here for delta, you will see that delta goes from 1 all the way to 0. That's a +1 all the way to 0. And then with the puts, we've got delta starting at basically -1 and going up to 0. So why do the call deltas, why are they positive? Why are the put deltas negative? Well, it kind of makes sense because when you buy or sell a call and the underlying stock goes up $1, well, your call option price also increases in value, right? It goes up in value, all other factors being equal. And if you're buying or selling a put and the underlying stock goes up $1, what happens to your put price, right? The put goes down in value, it loses value, all other factors being equal. So if I go back to the option chain for Google here, and let's imagine I buy a call. Maybe I buy this particular call here, the 135 call. You can see the delta on that call is 81. So what happens when the underlying stock, Google, the share price, currently trading at, we'll call it 146. Let's imagine that Google goes up in price to $147. What happens to my call option? Well, the call option price rises as well. How much does it rise? It rises 81 cents because it's 81 delta. Now on the flip side, if Google goes down $1, so it's currently trading at 146 and the market's open, that's why the price has changed. But let's just say Google's trading at $146 even, and it goes down exactly $1 to $145 even. What happens to my call option here that's 81 delta? Well, it loses value, right? It decreases in value by 81 cents. If I get rid of the call here and I go to a put, maybe I do the 135 put, and let's go ahead and buy that put. This is a -13 delta put. So what happens when Google, once again, rises $1? Well, if Google rises $1, my put is going to lose value. How much value? It's going to lose 13 cents of value. Conversely, if Google goes down $1, my put is actually going to gain value. So it's going to gain $13 in value because, again, it is a 13 delta. So that is how delta looks on the options chain. Again, it's all positive from 0 to +1 for calls, and for puts, it's 0 to -1 for the puts. But that's just how it's displayed on the options chain. Really, deltas are positive or negative depending on your directional assumption, because when we talk about if you buy or sell a put and the underlying goes up $1, the put should lose value. Well, is that a positive thing or a negative thing? Well, if you bought the put, that's a negative thing. But if you sold the put, that's a positive thing, right? Same thing with the calls, whether that increase of the call option, if the underlying goes up, whether that increase in value is a positive or a negative depends on if you bought the call or if you sold the call. So whether the increases or decreases in these option values are positive or negative for your P&L really depends on which side of the trade that you are on. So positive versus negative delta, the easy way to know if the deltas of your trade are truly positive or negative is to assess the directional assumption of the trade. If your trade is bullish in directional assumption, your delta on the trade is positive. If your trade is bearish in directional assumption, the delta is negative. And this is very easy to show you here on TASTYTRADE, because let me put on a directionally bullish trade, which if we're playing the wheel strategy, for example, what's the very first thing you do if you're trading the wheel option strategy? Well, you sell a put. Selling a put, a short put, is a bullish trade. So I'm going to sell this 25 delta put here, right? It says minus 25 deltas because in the option chain, the puts all have negative deltas. But remember, this is a short put. So it is bullish in directional assumption, so it actually means that those deltas are really positive. And in the review and send area here on TASTYTRADE, you can see that the positional delta of the trade is actually highlighted correctly. It's displayed correctly. My deltas are 25 positive deltas because I am selling that put. Now, if instead I was buying that exact same put, you would see that in the review and send area, it's going to show my delta as being negative 25 because buying a put is bearish, meaning those deltas are going to be negative. Anytime you put on a bullish trade, your deltas are positive. Anytime you put on a bearish trade, your deltas are negative. So let's say that we sell an at the money put. At the money means the put that is closest to the underlying stock price. That is typically right around the 50 delta mark. So if I sell an at the money put, I'm selling a 50 delta put. So the option chain, of course, is going to say that the put has a delta of negative 50, right? But remember, I'm selling the put. Selling the put, that's a bullish trade. So what is the real delta on the trade? The positional delta of that trade is actually a positive 50. And again, on the TASTYTRADE platform, it's going to accurately show that positional delta on the trade during the confirm and send process when you're about to enter the trade. Delta can also be used as a share equivalency. What this means is that delta can tell you what that option, how it acts in terms of had you just been long or short a number of shares of the underlying stock. For example, an options position with 25 delta has a similar directional risk to owning 25 shares of the underlying stock. Why is that? Well, a 25 delta option, it's going to move up and down by $25 for every $1 move in the underlying stock. That is exactly the same as if you just owned 25 shares of the stock. A 50 delta option is going to move up and down by $50, which is the same price movement as owning 50 shares of stock. A 30 delta option is going to move up and down by $30, which is the same as owning 30 shares of stock. And obviously, all of this was for positive delta options. Now, if we have negative delta options, a negative 50 delta option is going to move up and down by $50, which is the same as shorting 50 shares of stock, right? So if you're long or short, it's going to depend on whether your deltas are positive or negative. A negative 30 delta option is essentially the same as being short 30 shares of stock. Once you get very deep in the money, your delta becomes very close to being 1.0. Once you get to a 1.0 delta, that option position essentially behaves the same as if you simply owned 100 shares of the underlying stock. So let's talk about moneyness, probabilities, and delta. So when we talk about moneyness, we're talking about is the position in the money or out of the money. Sometimes we use the term at the money as well. The at the money option is the strike that is closest to the underlying stock price. So that's typically the 50 delta option, or the option that is closest to 50 deltas, because rarely are you going to have an option that is exactly the same price as what the underlying stock is currently trading. So, but there's always an option that is closest to that, so that option is called the at the money option. So if I go back to TASTYTRADE, go back to this Google options chain, what is the at the money option? Well, let's see, the closest one where Google is currently trading at 145.82, the one that is closest to that price would be the 145 strike option. So if I was buying the at the money call, I would buy that call, which currently has a delta of 54, but that is as close as we can get to 145.81, which is where the stock is currently trading. So that is the at the money call. The at the money put would be the 145 put. One of the great things about delta is you can quickly determine if an option is in the money or out of the money just by looking at the delta of that option, because a delta above 50 means the option is in the money. A delta below 50 means the option is out of the money. So if I go back to the Google option chain here, and TASTYTRADE, their platform makes this really simple because they have this orange line here. That is the in the money line. So all the calls that are above this line, these are the in the money calls, and in the puts, all the puts that are below the line are the in the money puts. They even have these options colored a little differently. You can see each of these four quadrants. You've got the two lighter quadrants, those are the in the money quadrants, and the darker quadrants are the out of the money options. But even if you didn't have that coloration, even if you didn't have this line, again, any option above 50 is in the money. So on the puts, all of these options starting here, 68 delta and above in this case, these are all the in the money options. And with this one, the 45 delta and below, these are all the out of the money options. So again, anything above the 50 mark in the money, anything below the 50 mark out of the money. One of the most useful things about delta is that delta can give you a rough estimate of your probability of expiring in the money. What that means is basically delta is a quick way to gauge your chance of winning on the trade and your chance of losing on the trade. For example, a 50 delta option has a 50% probability of expiring in the money, a roughly 50% chance. It's not an exact equivalence, but it's really close. It's so close that almost all option traders use delta as a quick way to gauge our chance of winning on a trade. A 30 delta option has a 30% probability of expiring in the money, right? A 20 delta option is going to have a 20% probability of expiring in the money, roughly. Now, as option sellers, like those of us that run the wheel strategy, right, we're mostly selling options, selling calls, selling puts. So we want our options to finish out of the money rather than in the money. So you can also think of a 30 delta option as, instead of having a 30% chance of finishing in the money, which is a loser, you can think of a 30 delta option as having a 70% chance of finishing out of the money, which is a winner for us. So one of the most common trades I make is selling puts. For example, if I was going to sell a put right now in Google, maybe I want to start the wheel and I sell the 26 delta put here, what is my probability of expiring in the money? What is my chance of winning on that trade? Well, 100 minus 26, that is 74%. So I have a 74% chance of winning on that trade, roughly. Again, that's not an exact, it's not mathematically exact, but it's pretty close. You can actually see the pop, the probability of profit for the trade is actually 77%, not 74%, but typically you're going to be within 1, 2, 3 percentage points on that. So it's really close. It's close enough that, again, most traders use that. If I sell a 13 delta put, I'd expect to have an 87% chance of winning on the trade. And you can see the pop for that is actually 87%. So again, it's really close enough that, again, as an options trader, the delta is just that quick way to gauge what is your chance of winning and losing on the trade. Another nice use case for delta is that delta lets you know when your option position is doing well or if it's in trouble. Remember, delta above 50 means your option is in the money, which is good for long options. It's bad for short options. So you always want to focus on that 50 delta, right? If it's above 50, in the money. If it's below 50, it's out of the money. And so depending on whether you're long or short the options, that could be a good thing or a bad thing. For me, I mostly sell options. So anything that is above 50 is an option that's in the money. It's in trouble, right? That's an option I need to be paying attention to. So let's take an example. Let's say I sell a 16 delta put and the stock goes down in price, which means it's going to start getting very close to my short put. My put is in trouble. Now the delta on that 16 delta put has changed. It's no longer 16 deltas. Now the delta on that put is 35 deltas. So a 16 delta put had about an 84% chance of winning. Now that put has a delta of 35. What's my chance of winning on it now? It's down to 65% chance, right? That's why delta helps you monitor your position, right? It really lets me know, hey, I need to be watching this put because that 16 delta put has now become a 35 delta put. Once it becomes a 50 delta put, I really need to do something. I really need to take some kind of action. And of course, that's for, a put that is kind of working against you. What if that short put is working for me? Let's imagine I sell that same 16 delta put and the underlying stock goes up in price. And now that short put, instead of having 16 deltas, only has 5 deltas. Well, that put has become very far out of the money. It's a big winner. I should probably take my profit and move on, because if I've taken a 16 delta put all the way down to 5 deltas, there's really not much juice left to squeeze out of that short put, right? I should just go ahead, take the money, and run. The last 2 bullet points here that I want to focus on talk about delta versus duration. Now, delta is delta regardless of duration, because many traders falsely think that the duration of a trade affects their win rate. Like a shorter dated trade has a different win rate than a longer dated trade. So for example, if I'm selling a 16 delta strangle with 45 DTE and I sell a 16 delta strangle with only 7 DTE, they might have different win rates. No, it's the exact same win rates because it's the 16 delta strangle, regardless of whether you sold it in 45 days ago or 7 days ago. They're both gonna have the same win percentages. If I sell a 20 delta put, I expect to win about 80% of the time. Whether I sell a 20 delta put that expires 60 days from now or tomorrow, 1 DTE, right? If I sell a 20 delta put in each, both of them have about an 80% chance of winning. So the percentages still are the same regardless of duration. The only thing that really changes with the duration of the trade is the P&L. You're going to have vastly different P&Ls because, like for example, a 60 DTE trade, I'm going to receive a lot more premium for selling a put that far out than I will with just 1 day out. So, the trades do act a little differently, but the win rates are exactly the same. So that was a very quick overview of the option Greek delta. Again, delta, in my opinion, it is the most important of the 4 primary option Greeks. Now, if you want to learn more about delta, as well as the rest of the option Greeks, check out my book, The Super Wheel Option Strategy. You can find that for sale on Amazon. You'll find a link in the description below. Also, if you would like me to cover the other option Greeks on camera, maybe do future videos about theta, gamma, vega, let me know in the comments down below. Peace, guys.